And now, to hear the stuff they don't want to teach you in school about money and finance, here's the Strategic Wealth Network podcast.
Hello, Strategic Wealth Network members. This is Sean. We're back for another podcast today, and I've joined Brandy Joe Newman again. Today, we're going to be discussing the disillusionment of the Wall Street promise and how it just seems with all the technological advances happening in the markets that the whole system of investing in that Wall Street promise, hoping that your money's going to be there at retirement, the whole thing is just rigged. And we're finding more and more clients that are just coming to that realization. And so the challenge becomes, how do you not play that rigged game and still come out ahead? How do you have enough money in your nest egg or build enough wealth so that you can enjoy life instead of trading those hours for dollars, so to speak? So let's jump right in. Brandy, give us a little background on, what your philosophy is with the market, what your philosophy is with Wall Street in general.
My background, and it's typical of, today's financial advisor. And, today's financial advisor uses and leverages information systems. They're not going, like my new colleague from Ohio said yesterday, we're not going belly to belly anymore. People want to understand the issues and be educated by the time they go in and sit down with somebody or sit across from somebody or get on Skype with somebody to discuss what it is that they want to do. They don't want to be led anymore. They do want to be led, but they don't want to be coaxed into something, because that's what happened in the dot-com bust, which was my first experience with this industry, and then the 2007 to 2009 recession. That's what happened. People were sold a bad deal. And, we can put on our tinfoil caps all day long and talk about how it's a conspiracy, but, look at it. Look at who makes money when the markets react and crash the way that they do. Look who is actually making money. It's only the smart people with a lot of capital,
or the ones that have the technology to crash the market. The high frequency trading platform type technology that's out there. And I just feel like it's an inevitable end to this compounding effect of technology. It's Moore's Law. Moore's Law states that every 2 years, the speed of processing power for computing doubles.
Wow.
I read a book called Abundance.
Okay.
It's a fascinating book. It's actually, if you buy it on the bookshelf, it's wrapped in aluminum foil.
Oh,
for a reason.
I've got to go find that one.
Yeah, and
that can be some Christmas gifts for some of our clients, I'm sure.
Sure. But the premise of the book is that aluminum was actually first discovered in 700 BC.
Okay.
By an alchemist, and the metal became so desirable because it was so light and flexible and shiny. It was actually competing against gold and silver at the time. People wanted it more than gold and silver. And so Caesar at the time beheaded this alchemist, and buried the secret. And aluminum wasn't discovered again until I think it was the 1700s when they first discovered the process of electrolysis, using electrical charge to extract metal. And so it wasn't that aluminum was rare. It was just that we didn't have the technology to get it out of the ground. And until we got it out of the ground and the technology had advanced to the point where it made it easy, now aluminum is so abundant that we crush it and throw it away. And so I think my philosophy about the market is that technology has advanced to a point where it's no longer belly-to-belly trading or buying and selling anymore. And it's no longer deep-seated, diligence and analysis of companies to determine whether or not a stock is priced right. I think it's just completely technology driven now.
Yeah, I think it's totally out of human hands. I totally agree with you. But it's the human hand that turns the market and makes the market go in certain directions.
Right.
Whether it's emotion or whether it's someone who, has the ability to actually do that. And I'm not one. I'm not one that can actually do that. But,
sure.
We do know that there are some groups of people out there that can. Back to the basics of, just pure education in what it is that we're trying to do here. What I was taught in school when I was, studying, financial services, financial calculations, economics 101, all of those things, is that the one thing that they forgot to teach everybody was that this whole financial services system, really not the economy and the markets, but the financial services system is based on people. And it's based on what they want to do with their money, not what they want to have happen to their money. So everybody's been sold on this thing for the last, basically since the Depression, that you put your money, in something that is going to grow over time and give it to some people up in New York or Wall Street or wherever, and they'll take care of it for you. What's that?
It's the Wall Street promise.
Right. And they say, don't worry, you'll have a great retirement. And what we're finding out now, just a week ago, I wouldn't consider them a client yet, but they called me and they wanted to talk a little bit. And they're originally from Illinois. Both teachers, 70 years old. I'm not sure on the date, but the pension, the state teacher's pension in Illinois is going to drop 20%.
Sure.
They passed legislation. They did all this stuff because basically Illinois is bankrupt.
Sure.
And so now their retirement at 70 years of age, now their fixed income is going to be 20% less. Mm-hmm. And now they're really into the casino mentality that now they're going to have to take more risk
They've got to make
in other areas. And how do you, as a, I grew up in an older family. So people who are 60, 65, 70, even, 80, 85 years old, I respect them immensely. And it is very hard for me. It's very emotional for me to say, if you don't make certain, if you follow the rules of Wall Street, you're going to get burned. Mm-hmm. But if you will learn and listen to what I have to offer, you're going to make some drastic changes that you're not going to be very comfortable with because you're not used to them. You don't understand them. You don't know them. You're not knowledgeable in that area yet. Okay. It's a husband-wife. The wife is actively trading on an account in their IRA.
Wow.
And, it's not her age. It's not anything like that. What I said to her.
Of doing that.
It's just the risk of, as a retail investor, there is no way for you to win.
No.
I mean, there is absolutely no way that you can win. I mean, it's like going to Vegas, and she's very proud of what she's done thus far. Mm-hmm. But, now they're 70. They've got some IRAs. They're going to have to, take the required minimum distribution. Not only do they, they as in the Wall Street people and the financial institutions that you and I are combating on every single day, not only do they say put it in there and leave it in there,
right? But
then when you want to go get it, we're going to tax you at the highest rate possible,
right?
That we can at that particular time. And then if you leave it in there, if you have income from other sources and they can leave that money in there, they're going to require you to make a distribution so they can get their hands on part of that tax money. So it's not only just Wall Street and saying, give us all of your money and let us keep it forever, but then it's the government on the other side of the coin that says, look, you can't keep it in here. We're going to need some of our tax revenue from that account.
Yep. I mean, if you think about it, though, this is the government's exit strategy. In their mind, they really believe that 86 million baby boomers all retiring at the same time, all taking distributions on their 401ks, IRAs, and mutual funds, is going to create enough revenue to sustain the spending, The problem with that thought is that the debt is expanding exponentially,
Right.
And that revenue, that tax revenue, central government tax revenue, is very linear. So you have this exponential rise in debt and a very linear rise in income. And that's where the dislocation happens. And that's what we're getting towards.
And people are starting to see the writing on the wall, and it's out there in visual form for them to see. All they have to do is Google it. There's a chart right there.
It's debtclock.org.
Yeah. But that's the whole, I think that's why, we're seeing such great success with the membership and with our business, is because people are coming to the realization that what they have been taught doesn't work for them. Now, it works for Wall Street and the government, but it doesn't work for them. There's a lot of people out there that are not willing to change, and they still have time to change. They're 45, 50, 55 plus, making hundreds of $1,000s a year. And they say, I think I'm okay. I think they'll be all right.
Sure.
Well, who wants to just be all right?
Yeah.
I don't want to just be all right. And that's, they're not experiencing pain yet.
Sure.
But they will.
Yeah.
And they will. But
yeah. And unfortunately, that moment is coming rapidly, because of that exponential increase in the problem. Everything compounds, Interest on the reserve capital accounts compounds. Debts compounds. Problems compound if you don't address them. You tell me, name one problem you've ever solved by kicking the can down the road. Can you do it?
No, and I still have that problem.
I do too. It's human nature. That's the problem. And so that's really what we're talking about, is just the psychology of human behavior. At some point, we always revert back to self-preservation as humans.
Yes. And that's, we've experienced that trying to build this platform, trying to make it simple every single day. We think of a great idea one day, and then, we run with it for about 3 or 4 weeks, and then it's like,
it's old news by then.
Yeah. Then it's like, no, let's go back to what we know.
Yeah.
Let's go back to foundational.
Yep.
Let's go back to,
That's why systems based on principles or rules are always, always, always going to be used by the wealthiest families.
Right. But that's not sexy. That's not sexy boring to the guy who's watching CNBC and Fox Business News.
Yeah, exactly.
He wants to play.
Right.
He wants to, experience the,
right.
The ups and downs. He likes the emotion, or the roller coaster ride.
Yeah. I usually,
and that's fine. You can do that with part of your personal economy.
Yeah.
That's fine.
I usually tell people that
to have that foundation.
Yeah. I tell people that we only work with the money you don't want to lose.
Totally.
So you can play with the market as much as you want, but we'll handle the money that you don't want to lose. We'll show you how to handle it.
Right. If you want to play their game, just go play their game with somebody else's money.
Right. So have you had a lot of clients kind of wake up and come to the realization, or just a couple of clients here and there? Or what's the kind of the trend, if you will?
I have a new client that is actually better at this than I am. And he is on the ball. And what I mean by that is, when we go through underwriting, there's always certain things that the underwriter wants to know. And we're actually putting a significant amount of death benefit on this particular husband, wife, and the 4 kids. And also he has, at last count, $15 million revenue in his business. So his business is basically worth about $35 million.
So how does the insurance company value that? How do they calculate that value?
Well, we're doing 2 things with this particular case. This case now involves 6 different reserve capital accounts. And the way that the insurance company says you have to cash flow these policies up until a point. And most of the time, when you and I are dealing with superior entrepreneurs, they have a way of making an income, but not having that actually go on their tax return.
Sure. I mean, they're smart. People use the tax code to their advantage, you know.
But when the insurance underwriter gets a hold of those tax returns, you know, where's the money going to come from? Because not only I work for the client, we work for the client, but we also represent in the best possible way the insurance company to make sure that both parties are successful going forward.
Absolutely. You don't want to collapse the company for obvious reasons, you know.
Right.
Nobody wins.
So then comes in not only the tax returns, but a financial statement, an audited, certified financial statement by a certified public accountant to say, you know, what is the real income for this person? Because if you're just looking at dollar for dollar, it's not going to be there.
Right.
It's not going to be there because there's other value in not only their business, but also their business pays for some of their lifestyle. That's just the way that it is when you own your own business.
Right.
Amber is a perfect example of that. She not only enjoys a salary, but her company pays for her car. Her company pays for her child care. Her company pays for her health care.
Yeah.
Not only does she, run the company, but there are other things that are not on that tax return and that are not part of her adjusted gross income. So that's one of the issues that we always have when we're going through underwriting with a client, talking to them about, you know, your CPA and you have done a good job making sure that you only make $250 a year.
Yeah, and that's
but when we're talking about $8 million of death benefit, which is
a lot of risk.
Well, but which is also not his human life value, because you have to take into account the ownership and the assets that are part of his personal economy and also part of his business economy.
Sure.
So when you look at it, $8 million really isn't that much money when we're talking about what all he has available to him, but we have to show the cash flow.
Right.
We have to show the cash flow on the base premium alone. Now, the PUAs and the 1035 single premiums, not that big of a deal.
Sure.
What he's actually doing, he is getting rid of a $750,000 portfolio that has done nothing. He should have had some sort of rebound from 2009, 2010, 2011, and especially 2013, where everybody's making 31%.
Sure. But the problem is, if you're a retail investor,
and he's a retail guy because he goes down to the corner of his Merrill Lynch dude or his buddy or whoever or the Edward Jones guy. I don't know where the account is, but that's a retail investor.
Right.
Now, what can you do with an active money managed account? I mean, you can do a lot of things with that because it's actively managed on a daily basis. It's not a, sit and watch a mutual fund for 6 weeks and see what it's going to do.
Right.
So he's done with that kind of Wall Street investment. He's totally done.
Yeah.
And the productive asset side, because this is the thing. He owns the business with his other brothers. And one of the things that he had struggled with for 10 plus years is the fact that he's now considered rich, but he didn't know what to do with his money. I need to meet a rich person so they can show me what to do.
Isn't that interesting?
And it took him a year and a half to find me. And he had gone through a couple of other agents, and they just couldn't put it together for him. And I think that's one of the things with the reserve capital strategy and utilizing whole life insurance the way that we do is that the agents get in the way. It comes to a point where you have to design and implement the policy and show them how to use it.
Sure. Yeah.
It's way beyond concept and theory with this guy. I mean, this guy is so ready. I had a phone conversation with our GA this morning about this case. We're trying to present it to the underwriter in the most efficient way possible because we need to get this done before the end of the month.
Interesting. Yeah, you were talking about the challenges with underwriting an entrepreneur or a client that owns their own business like that. Same is true when you're getting a loan at a bank. I've got a client right now that we're actually he's a physician, spine surgeon, one of the best in the state. and he, sees the writing on the wall. His income has already been cut in half, and his number one procedure for helping patients to recover from injury has been taken away from him. He can no longer utilize it. They're calling it recoding.
Because of ACA?
Yeah.
Oh.
Yeah. So he told me, 3 years ago when we first met, I said, what's your mission and purpose? What are we trying to do here? And he said, I want to be out of the medical industry in 3 years. This is a guy that has trained his whole life to do what he does and loves what he does. He's very good at it, and he only wants to get out. And
another perfect example of the government coming into their business where they shouldn't be.
Sure. But so he's tactical and he's strategic. He's implementing the reserve capital strategy, and he's using it to manage his business right now, the overhead in his business and the income and revenue he gets. He stuffs it all in and borrows out or borrows against it when he needs to when he has a capital expenditure, new equipment or overhead expense or whatever. And he met a medical group that is they're opening clinics that do hormone therapy for men, testosterone therapy, which is a huge market right now.
Huge.
Because, again, 86 million baby boomers all retiring, and they have these accounts now. And when you retire, you want to play, right? I mean, that's why you stop working, is so you can play.
That's the whole point.
And when you start playing, you spend money. And so they're spending that money right now. And it's just a huge market. And he sees the future and sees the writing on the wall. And what's nice is that he's an owner of the clinic, not a worker bee in the system, kind of. That's really what he's getting, is he's becoming an owner in this business with this medical group. And so he's in the process right now of opening up his first clinic, and he's going through underwriting on a small $350,000 loan, and he has at least $150,000 in cash in his life insurance account.
Right.
He's got gold and silver, probably about $50,000-$60,000 in gold and silver. He's got almost enough money to pay this loan back today. And these clinics are making so much revenue, cash revenue, that the loan makes perfect sense. He goes through underwriting at one of the banks. I'm not going to say who it is because I don't want to embarrass him. They deny the loan. So I get on the phone with the loan officer as his kind of, team captain.
Financial advocate.
Yeah, as financial advocate or whatever, saying, because I know how loan officers work, and I know how underwriters think. The underwriters are there to deny the loan and protect the bank. That's their job. The loan officer's job is to get them to approve it anyway.
Right.
And what they're not doing is walking the client through and showing them or educating them on the process of getting a loan. And so what he does is he sends a financial statement in his bank statement that shows like $7,500 in cash and savings, and that's it. And so they deny the loan. And he's like, Sean, I don't understand what happened. And I'm like, so I get on the phone, clarify, show him, insurance account statements with more than enough cash to service the note for years, that kind of thing. And so we'll see, they have to hit the reboot button and start all over. But yeah, it's interesting. When you're underwriting these entrepreneurs, his tax returns did the same thing. They showed that he made no income, even though his top line revenue was almost $1 million.
Yes.
and so the bank underwriter's like, well, where did all that money go? Well, it went into investments, and he bought tax credits, which zeroed out his tax liability for most of his net, income tax due.
Well, and that's the problem with dealing with underwriters, whether it's a bank or whether it's with, a really great life insurance company, is that the underwriters are not educated in the process of what it is that we're trying to accomplish.
Sure. So there's a wave of financial education taking place right now with these institutions, which is interesting to me. Bank of America, Chase, they now have educational content on their websites. Mm-hmm. What's interesting to me is what type of education is it? It's the Dave Ramsey, Susie Orman approach. Mm-hmm.
Yeah. Give us all your money, lock it away, and we'll let you have it if
it's the same old. It's
right.
product
It's the same
sales.
rules.
They're essentially just selling. The difference between what you and I do and what the rest of the financial world typically does is that they're selling product. We're trying to solve problems.
Right.
That's essentially.
Ooh, that's good. I like that.
So, but yeah, I hear you with these clients. It's tough because, it's just this new economy has thrown everybody for a loop. Mm-hmm. The Dodd-Frank rules have changed so much that with this doctor, this client of mine, he one of the underwriting requirements was you have to have 2-year history tax returns in that same business to qualify for the loan.
That doesn't make sense.
So think about this. You've got a sea change of employment shift happening right now. People are being laid off and they're having to start their own business. They're having to become more entrepreneurial to supplement their income or drive more revenue in the door. And so they're going to banks that are cash rich right now with reserves at the Federal Reserve level, right? I mean, we saw the chart yesterday. There's $6 trillion difference between what the banks have and what they've actually lent out. So there's $6 trillion sitting there, and one of the rules to qualify for a new loan to start a new business is you have to have 2 years history in that business. How much sense does that make?
It doesn't make any sense whatsoever, because if someone's willing and able to take on the risk of their own, then why not? And how much does that rule right there dampen progress and technology and innovation?
Yeah.
No, when someone thinks of an idea, they haven't been doing it for 2 years.
No, especially with the technological advances that we're seeing now. Yeah. I mean, we're coming up with these 19, 20-year-old kids are coming up with $19 billion ideas overnight. And you're telling me that bank won't give you a loan to start it up?
Well, that's why you have private equity.
Yeah, I guess that's why you have VCs too, right?
Exactly.
It's a different world, that's for sure. Well, ladies and gentlemen, thank you so much for listening in to today's podcast. And be sure to check the site out and, dig around. Look at these different strategies and concepts and ideas and really ask yourself, how can I apply these to my own personal economy? How can I apply this information to the new economy and to my own personal economy? All right. I look forward to hearing from you, and we will talk to you soon on the Strategic Wealth Network.